Corporate finance practice problem using OneNote, cost of debt after tax interest rate calculation. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, and then in the 1119 Cost of Debt After Tax Interest Rate Calculation. Also note, when using OneNote, look at the immersive reader. Many of our practice problems are mirrored down here in the text area. Same name, same number, but transcripts included here. Transcripts that can be translated into multiple different languages and either listened to or read in them, making them good complements to presentations. Closing up then icon, we have our information up top. We will then go through the calculations for it on down below, keeping in mind in the back of your mind in this section that we're looking at financing type of issues. When you're thinking about financing type of issues, getting money, getting capital for the operation of the organization, you have two categories, two main categories, that being debt, that being equity. We're focusing here on debt. When you're dealing with debt, you also have to be dealing with the tax consequences because you have interest typically, which will have a tax consequence due to it being an income statement type of thing and the tax being an income tax. And so now we're going to be looking at the bond type of situation. So when you're looking at bonds, also note you have the added level of complication in that there's going to be a rate on the bond, and there's also going to be a kind of a market rate or yield to maturity type of rate. And so your question is, well, which one am I going to use with my calculations here? And the answer typically will be the market rate. We'll discuss kind of why that would be. It might not sound as intuitive as to why it would be, because you might be saying, hey, look, I mean, it seems like I'm actually paying the interest on the interest rate on the bond. And so why would it be like the market rate? But the difference between the discount and the premium is something that we basically are going to amortize and in essence expense in some way typically. And therefore, that's really kind of the true market rate. That's what we'll use. So hopefully that'll become a little bit more clear. But just in terms of practice, you just kind of want to memorize that of the two, you're basically using market rate. So we have the par value, we're saying is the 1,000. We have the years to maturity, we're going to say is 25. The annual interest payment, we're going to say is 90. That means that the interest rate on the bond is 90 divided by 1,000 or 9%. So 9% bond interest rate. And then the current market price is 930, tax rate 35%. So note what they did not give us here. They did not give us the rate, the market rate, but instead gave us the price of the 930. If they had given us the market rate, it's a fairly straightforward problem because then we can just take that market rate. The question then would simply be, do we take the market rate or do we take the rate on the bond? The rate on the bond, in essence, 90 divided by 1,009%. Market rate is whatever it will be. We'll have to figure it out now. But if we had that, then we would choose the market rate in order to do our calculation and then do a similar calculation that we have seen in our prior debt kind of problems. So here we got that added step of trying to find the market rate based on the current market price. Little added bit of difficulty. This first step, however, something that we did basically in the prior section when we talked about just bonds in general. So we have to do that first and then do the new thing, which will be fairly straightforward as long as we pick up the proper rate, which will be the market rate, which is the one we're thinking finding here. Okay, so first I'm going to think about how we can do this first part, just basically find the market rate using GoalSeek, because it's a little bit more complicated of a problem than you kind of think. And again, you can look at the prior presentations in the prior chapter to get more information on this, so I'll go a little bit faster on it. But first we kind of want to think about our normal calculation if we had the market rate, and then try to back in what we should do to back into it. Normally we would do a present value of an annuity, and then present value of 1 for the series of interest payments, the annuity for the payment at maturity, present value of 1, using the rate, the market rate, and then we would add them up to get to the total. Now, it's a little bit difficult to come up with an algebraic equation then, because these two components were basically adding together two formulas here to find the unknown. So you could do it, but it gets a little bit long to do, and so therefore it's really useful to use something like Excel in order to do this type of calculation. There's two ways that you can do that. You could do that, one, using this same calculation and then using GoalSeek, and two, you can use the rate function. However, even if using the rate function, you'd still want to probably check your answer with the present value of annuity and present value of 1 calculations. So let's do it the first way because I think this is actually a little bit more intuitive way to do it. We do this in Excel as well if you want to see all the steps within Excel to do this too. So let's imagine that we have the goal seek here, and what we would first do is come up with some rate. We're going to imagine a rate. So this happens to be the answer, but when we first start, we could just put 5% or whatever here to start with so that we have something to fill out our function with, because this cell is geared to or included in both these two calculations as well as this totaling up these two cells. Then we can then ask Excel to change this number. Say, hey, Excel, would you change this number to see what it should be in order to get this number to know what it needs to be, that being the 930. And we can basically do that, and Excel will do that basically automatically and allow us to do that. So if we would do the present value of an annuity, it would be negative present value. The rate then would be, we're assuming this rate, which when we started off would be something that possibly we don't know what it is yet. We would just use that cell with something in it, comma, number of periods, which would be the 25 periods, comma, and then the payment was given at the 90, which means a 9% rate because it would be the 1,000 times 9% would be the 90. That would then give us the present value of the annuity, 832.45. Then we'd get the present value of 1, which is the 1,000 at the end of the maturity date. That would be present value of the rate, which once again would be the this rate that we would be using up top. Number of periods would be 25. And then we would not have a payment this time and instead have the future value. I'll go down here this time, which would be the $1,000. That would give us the $97.55. Adding these two cells up would get us to the price. Now, if we just guessed what this number should be, the price would not match what we think it should match, which is that $930. And we could basically ask Excel to then change this cell, just basically with brute force, until we get this cell to be what it should be using a tool called Goal Seek. It can basically do that. In that format then, we can kind of use this whole kind of function as if it's an algebraic equation, as if we're solving for the one unknown without reworking it to solve for that unknown, right? We can just basically use Goal Seek to find it through trial and error. And that's one method. I think that's one of the more intuitive methods. There's also a function in Excel to solve for the rate, but it's a little bit more complicated of a function. And again, you get there nice and quickly and easily if you plug in the information correctly. But once done, you probably still want to check it by using that rate to then calculate your present value of the annuity, present value of 1, and see if you do indeed get back to the number that you think you should, that being the 930. So this formula would be equals the rate, brackets, and then the number of periods, which is going to be the 25, comma, the payment that is going to be the 90, which would be the 9% of the 1,000, comma, the present value. Note here, you got to put a negative here or else it will not calculate properly. So it's got to be a negative present value. That's going to be the price now, the 930, which this is known to us, comma, and then we've got the future value, the future, hold on a sec, the number of the present value is going to be the 930, and then the future value, which is going to be the 1,000, up top. So let me see if I can get these correct again. The thing that has a negative in it is the payment amount, the payment of the 90, and then the future value of the 1,000. Those are the things that need to be negative. The number of periods, and then the present value, not negative. If you do that properly, you get to that 9.76, and then once you have that, I would then double check it with your normal calculations. Once you have the market value to calculate the present value of annuity, present value of 1, double checking that you do indeed get down to that 930. Okay, so now that we have that, then we can do our normal kind of calculation to take into consideration the tax impact. So we could do our cost of debt after tax kind of calculation. We're just going to do a similar thing that we did in a prior presentation. Now we've got the interest rate, this being the market rate, this being the main question or the new thing from the prior bond, like looking into bonds. That's going to be the 9.67 as opposed to the bond rate, which would be 9%, 90 divided by 1,000. Then we've got the 1 minus the tax rate, or 100%, or 1 minus the tax rate, which was said to be 35%. So 1 minus 0.35 or 100% minus 35%, that will give us the 65%. Remembering the logic here, we're basically saying, this is the change that could be happening to net income that is going to have a tax impact. Of that change, we got the 35%, which we're basically going to get back in taxes. We're going to have to pay the interest on it and kind of get it back in taxes to some degree. So therefore, the amount not impacted or that we're not going to get back is going to be the 65%. So if I take that 65% times the 9.65, that's going to have a cost of debt at the 6.34. So we're saying, okay, for the bond that is issued, we have a couple rates. We've got the 9% rate on the bond, which is the actual interest rate that we're paying. But when we think about the cost of debt, we're really think about the market rate, the 9.76. Now, why does that make sense? Why is that the market rate? Because we're going to actually expense the actual money that we're going to pay, right? So how does that make sense? Well, the difference between the 930 and the 1,000, in this case being a discount, if it was going the other way, it would be a premium. That difference is something that's going to kind of, we're going to have to, from an accounting standpoint, we're going to have to basically amortize it over the life of this thing, either straight line or using an effective type of method. And therefore, the real difference is going to have an impact on the income statement over the life of the bond, and therefore on average we can kind of use the market rate. The market rate is actually basically the cost that's we're using, even though we're paying interest rate at the rate on the bond. So we're using then the market rate, which is kind of appropriate, and then we're adjusting for taxes on basically like an average kind of annual basis, being the 6.34. So there we have that. Now if I was to put that into our example, just to calculate this out, it'll look something like this. We have the interest market rate. If we have the debt of 1,000 times the interest that we had, remember we just calculated the interest up top at the 9.76, that would be once again the market rate. That's not the actual interest we pay, but that's kind of the interest when you take into consideration the payment price that we receive, the difference between either the premium or discount, in this case the discount. And so we've got the 1,000 times the 9.76% is 97.57. Taking then into consideration the tax benefit, we have the interest expense or deduction, the 97.57 times the tax rate, the 35%. That's going to give us the 34.15. If we take then the 97.57 minus the 34.15, we get then a cost of debt after taxes, the 63.42. And that's in dollars. If we then take the cost of debt after tax percent, we're going to take that amount, divide it by the original debt, which have the 1,000. That would then give us our 6.34, which is of course our 6.34 up top. Confusing thing about this, again, is the fact that you're looking at this rate and you're saying, well, wait, that's not really, that rate isn't the rate that we're actually paying the interest on. But you got to consider the fact that the difference between, in this case, the discount and the amount of the bond is basically interest and will have a tax impact over the life, you would think, given the fact that we're going to amortize that in some way over the life, that difference then having an impact on the income statement as we do so. Okay, so let's go back down and let's do this again, this time with a premium. So the par value now 1,000. The year to maturity 25, the annual interest rate now 90, the current market price is now 1,115. So now it's at a premium tax rate at the 35. So the difficult part is to find the market rate first because they didn't give it to us. This is the part of the problem that's really in the bond, kind of in the last area that we looked at where we focused specifically in on bonds. And now, so we got to find that first so that we can use the proper rate, which once again is the market rate as opposed to the rate on the bond. So if we used GoalSeek to do that, we could say, okay, we'll just plug something into the rate calculation and then do our calculations as we normally would if we knew the rate and we're looking for the total price being known to us given here. Then we'll use GoalSeek to change this amount to whatever it needs to be to get to the end number that needs to be at. And that's kind of like using algebra without reworking. The same kind of algebraic concept. We only have one unknown within this whole set of series of things. but instead of reworking everything to solve for that unknown, we'll use brute force trial and error. So we've got the present value of the annuity, which would be the present value of the rate. The rate then is this amount that we're just going to make up first, and then we would change it to what it needs to be, comma, number of periods, which is going to be the 25, comma, the payment, which is going to be 90 on the payment. And that will then give us our present value of the annuity, 966.57. Present value of 1, present value of the 1,000 at maturity, would then be the present value of the rate. The rate is going to be this amount up top again, comma, number of periods, which is going to be 25, and then not a payment, but rather the future value, because it's present value of 1, that 1,000, that then gives us the 148.43. Adding the annuity and the present value of 1 gives us the total. If this had not been, if we didn't have the answer up here, if this was something other than the percent being used, like 5%, we can then ask Excel, would you please change this cell to whatever it needs to be, just using trial and error, using brute force to get to this end number to be what we know it should be, because it's part of our data set, so we can then solve for the unknown in that way. Now, you can also use another formula called the rate formula to do this. Even if you use the rate formula, however, once you get the number, you still probably want to double check it with the present value of annuity and present value of 1. Rate formula looks like this, equals the rate brackets number of periods, which is going to be 25, comma, you need a negative number here, the payment, which is going to be 90, comma, future value, the present value is going to be the 1115, the price, comma, future value, you need a negative here, and this is going to be then the 1,000 that will be there at maturity. That should give you the 9.9793, which you can then double check with your annuity calculations. Also note that when you use this method, and either method you use, you should have kind of an idea of what you expect the rate to be, because I know the rate up top is 90 divided by 10 divided by 1,000, which is 9%. So I know what the rate is for the rate on the bond. They're issued at a premium. So if they're issued at a premium, that means that basically the rate on the bond has to be higher than the rate on the market, because the people on the market can't get any other investment that's similar at the same rate. Therefore, they're willing to pay a premium. So you would expect then this number to be lower than, in our case, 9%. If it's not, then that's an indication that either you're thinking something wrong and you got to mull it over a bit till get it figured out. So then we can plug into our cost of debt calculation. So the interest rate is now 7.93. Big point here, we're using the 7.93 market rate as opposed to the 90 divided by 1,000 bond rate. And once we have that, then we have our same calculation we saw in our prior problems for debt, 1 minus the tax rate, or 100% minus the 35%, which is the tax rate. You can also think about it as 1 minus the 0.35. That gives us the 65%. 65% or 0.65 times 7.93 or 0.793 gives us the 5.15. So this then being the rate, 5.15%, that we think of as the cost of the debt as opposed to the 7.93. Again, if you look at this, a little confusing because you got three rates here. Rate on the bond, 90 divided by 1,000, the rate we actually pay, but we issued at a premium. We issued at a premium because the market rate in essence is different. That means that when we record it, we're going to have to basically amortize the premium over the life of the bond, so it will have an impact on the income statement and therefore a tax impact as well. And so the actual rate, basically kind of like an average rate in general over the life, we're thinking is going to be this 5.15%. Now, if you plug this into like our example, just to calculate this out to make sense, to kind of make sense of it, you'd say, okay, the interest is going to be 1,000 times the interest rate, which is the market rate. Again, this is a little tricky because this rate is basically the market rate, kind of not the rate we're actually paying, but you can get an idea of what the interest expense will be over the life due to this, because you're going to have to be amortizing, the premium. And that's why it kind of makes sense. So we got the 1,000 times the 7.93 is the 79.29. Then we can look at the tax benefit. That would be the interest expense, which we're assuming to be 79.79 in general, times the tax rate of 0.35, tax benefit 27.75. Therefore, the 79.29 minus the 27.75 gives us the 51.54 cost of debt after taxes in dollars. Then we can calculate the percent cost, which would be the cost of debt after taxes in dollars, 51.54, divided by the debt, which is the 1,000, giving us then that 5.15%.